So in video 1, we killed the idea of using traditional ways of mapping market structure to dictate our entries. Instead, we're reading higher time frame candles and we're looking to execute towards higher time frame targets that are exposed in the market. But when do we do that? We need to understand who is in control on our execution time frame, and we can see that through order flow, and it's way simpler than it sounds. So what is order flow? Well, what it is not is any complex indicators or deeply understanding order book data or institutional software. All we need to really understand is where is volume in the context of our higher time frame trades. And we can see that through candle closures, because candle closures on our execution time frame create price legs that we can trade from. So what is a price leg and what is order flow in this context? Well, think about what's going on in this example. We have bullish aggression in the market. We then get sell pressure, and then bullish aggression in the market continues. So we get buys. So we have sell candle followed by bullish aggression and volume. Why is there volume here? Because we see the expansion of price in a bullish direction. Second thing that we can see to indicate volume in this range of price is that between candle 1 and candle 3, we get an inefficiency. So this candle moves so aggressively in a bullish direction that anyone looking to trade in this range just got left behind. That only happens in Forex markets, in highly liquid markets, when there are big orders being processed in one direction. So that's our cue for spotting volume in the market. So we can now mark a price leg, and a price leg is simply formation of an order block followed by aggression close above the order block, dictating new swing points, low and high. And most ideally, we would like to see an inefficiency within the price leg. So between the low and the high, we start to get the creation of gaps or fair value gaps. We've got a whole lesson coming on that. What then happens next is we either trade into this internal range liquidity and away, or it gets disrespected and we continue in the opposite direction. What would have to happen for us to trade in the opposite direction? Well, this candle would probably disrespect this entire area. It would close through this area, creating a new buy to sell. That would create an opposing price leg. So if we start to understand what price legs are and how to see them on our charts, we can then just plot them in context of higher time frame candle closures. So what to look for? Last directional price leg containing order flow. So we can get price legs that do contain fair value gaps and price legs that don't contain fair value gaps. But to really understand order flow, you need to see those inefficiencies in price. Internal range liquidity contained in price legs. Are there order blocks? Are there fair value gaps? And are there breaker blocks? All of this we're going to explain later in the series. Is the price leg in context of higher time frame alignment, and is it printing at the right time? Again, something we'll cover in more detail. And then finally, multi-time frame analysis, because these print on every single time frame. So if we are starting to place trades, what's happening on the higher time frame from an order flow perspective that can give us more confluence that our trade is going to play out. And this is where we start to explore key levels. But for now, let's look at the 12-hour price action in context of our higher time frame alignment. So we just ran through why price exploded in a bullish direction right here. We have an accumulation candle on the weekly. We have an order block on the weekly. Price mitigates the order block, liquidates this candle, manipulating it by raiding below and closing inside. We then expose this as our high. So if we just mark that very quickly, we have order block right here. Why is it an order block? It's the last sell before the buy on the weekly time frame. So it's a weekly order block. We then have a liquidation of this weekly accumulation candle right here. So we can mark that. We then see the creation of a target in the market right here, which is the high of the weekly accumulation candle. And if we go back to the 2-week time frame, we see that price at this point here closed above the previous 2-week candle. So we are looking for longs. So everything is now in alignment for us to go higher. We come back to the weekly time frame. How can we start to map price legs and as such order flow? So what we see obviously is extremely bullish aggression right here. So from a 12-hour perspective, the 12-hour order block is here. It's right down here in this specific last sell before the buy. So we can't just sit and place an order here and wait and hope for the best. Similarly, the last fair value gap or inefficiency in price was created here. So is price going to fill the fair value gap and go higher? We see straight away bearish aggression into the fair value gap. So the best thing to do is wait and see what happens with the creation of this candle. But what we see is essentially a newly created price leg. So we can see this because we have a buy to sell. And in doing so, we create an order block. And then what do we get? We get inefficiencies in price starting to print. So we can see inefficiencies because these candles are so bearish. We actually don't get a fair value gap at this specific point. Price then creates a new price leg by creating a bullish order block and then a sell-off. So we get order block and then you see candle 1, candle 3. Let me just zoom in here so it's super clear. You see, here's the last buy before the sell. And then if you look right here, there is an inefficiency in price. So we can mark that as a bearish fair value gap. Price is so selling off so hard that we don't get any mitigation of these internal range areas. Price just drops away again. So we can clearly say that we're getting bearish price legs. Even though we had this bullish order flow has shifted because we now have bearish aggression, closing below these swing points. So this would be the previous swing point. We've got the low, or the high in this case, the low. We then get a new buy to sell. So we now have a new high right here. This is no longer relevant. This is our higher time frame target, but this is not the high of the current price leg. It's right here. This is the low. It's been traded through. And then what do we get? We get another buy candle and then sell off. So this is now our next order block right here. Buy to sell. And then eventually we get the creation of another imbalance. Candle 1, candle 3, imbalance. But now, crucially, what happens? We have price has achieved its target. So we have bearish order flow into this liquidation. But everything from the higher time frames are saying we're going long. So now we need to wait for our trigger. Well, what do we see? We get sell to buy. And in this sell to buy, we get candle 1, candle 3, bullish aggression in the market right here. So this is a bullish fair value gap. We have created bullish order flow, a bullish price leg. Here's the low, it's our swing point, and here is the high right here. So when this candle finishes printing, we now have full alignment, full time frame alignment. We had bearish order flow coming in. We now have the creation of bullish order flow. We have bullish weekly order block, liquidation of a weekly accumulation candle, and the creation of a higher time frame target in the market. So even if you don't understand anything about internal range liquidity, but you've seen that the creation of this order flow, at the close of that candle, you could place a trade, cover the low of the order flow or the price leg, and target the high. that plays out for a 2.21R trade. What we're now going to look at is internal range liquidity, because within this price leg, we create fair value gap, order block, swing points. Sometimes we're creating breaker blocks, and we want to know when and how to trade from all of those points of internal range liquidity. Because just by understanding that, you could refine this ever so slightly, and your trade now becomes a 2.5R trade. And that's what we're going to look at next.